Hello there, welcome to the channel. So today I want to talk about this oil price cap proposal that the G7 is talking about. Okay, so I looked at this for a little bit and got some information from there was a Reuters article on this, and so let's go over a summary of like at least what I'm hearing about this oil price cap. So, who is it? It's basically going to be the G7 nations. So it would be the US, Japan, Germany, France, et cetera, all the big guys like that. And what is it? It's a cap on the price of seaborne oil shipments from Russia, and it's due to start on December 5th. And what they're proposing is to fix the price at something like $60 to $70 a barrel. Currently, right now, oil is priced at around $100 a barrel at this time. So the idea behind this is that what they want to do is they're sort of acknowledging that Russia supplies a significant portion of the world's oil supply, approximately 12% of the oil supply. So what they're doing is they're trying to set up some kind of a plan to try to reduce the income that Russia will get from their oil by lowering the price or fixing the price in this way. That's what they're trying to do. Now, how would this work? It would be enforced via the insurance finance brokering, which is dominated by the West. So basically, once again, you know, if you're sending a ship of oil somewhere, that ship has to be insured. There has to be financing involved, insurance, all this stuff has to happen. And that is dominated, like 95% of that stuff is handled by Western companies. And I believe in the UK, as a matter of fact. So that is how you would implement this. You'd basically be saying, hey, you're shipping oil from Russia to the US, Russia to Europe, Russia to Asia. Okay. If you're participating in this, you have to assert that you didn't pay more than the oil cap for that oil that's being shipped. And if you didn't, then we're not going to insure you. We're not going to finance it. We're not going to do brokering. And then the hope is that that will prevent that ship from being able to sail and be able to actually offload the oil. Conceptually, you're talking really big ships, really big ports. You can't just go into a port without an insured anything happens, you need to have insurance on that ship, et cetera, et cetera. That's the thought here. Now, the response is that Putin is stating that he's going to cut exports to any countries participating in the cap. So he's basically doing what you would expect him to do, which is like, hey, I'm not tolerating this, forget about it. This is, I'm not going to do this. And then the question is on enforceability. I was looking at several articles, and one of the Reuters article quotes industry source that estimates that 85% of Russian oil could avoid the cap. So that's kind of an interesting thing. On one hand, you're talking about they hope that they'll be able to enforce it because, the West dominates all the financing and all the behind the scenes part of making the oil flow. But then there's other people saying that, well, there's a way for them to just totally get around it. So it leaves sort of, an open question how feasible this really is. So now let's look at kind of hedge our bets here on this thing. So if we look over here, what I'm doing is I'm just trying to like look at some potential options, things that could occur. So here we go. We have the oil price cap, and I see, right out of the gate, two ways this could go. Number one, actually implemented. There actually is a price cap that is actually implemented, and the other is that there's no price cap implemented. So what I'm doing is I give it a probability of 0.8 or 80% chance that they'll actually implement the price cap in some form, and a 20% chance that they won't. So look, if they don't implement the price cap, then as it stands, this should have no effect on oil price, oil dynamics, because they haven't done anything, right? So now the question is, okay, they actually going to implement something. And once again, we're getting into this situation about saving face. The West has been talking about this for a long time. So at this point, hey, they're going to implement something. Whether it's going to work or not doesn't really even matter. Right. We're talking about, saving face, meaning that we'll have to show that we're doing something. Okay. So now if it's actually implemented, we have a variety of choices that I was kind of looking at here to try to figure out, well, what could happen? If I look at it, we could look at one case and say, hey, this works as planned. Russia, and there's two parts of this. The price cap as implemented at whatever, $65 a barrel is actually implemented, and actually countries are complying with it. And in addition, Russia is continuing to sell that oil within that price cap. Now, I've given here kind of there's two things. One is that this would be beneficial for some economies because basically, if uh, economies that are paying $100 for that oil, like Europe right now, just keep in mind that right now our understanding is that like China and India are buying Russian oil at a discount to the price. So the estimate is something like $30 a barrel. So they're paying $70 a barrel right now. They're paying not far from the price cap as it is. But the other countries that are not getting that discount, the unfriendly countries like the US, Europe, et cetera, we're paying whatever the market price is. So if it worked as planned, then it would be beneficial to those economies like the EU and the US that would, we'd be paying less for that oil. We'd be paying the price cap. So, but the thing is, I gave this a probability of 0.1. Uh, and the reason is that it's very unlikely that Putin is just going to go along with it without some putting up some kind of a fight. I mean, you have to think about it. Look, he's going to have to save face. He can't just say, "Oh, okay," and just implement it and allow it to be implemented with some kind of pushback. So this is a very low probability. So basically, what I'm doing out of all the choices here, I'm trying to pick a probability of like how likely is this to occur. So if Western leaders are thinking like this is actually going to work out how they planned, it's a very low probability of that. There's no way he's going to push back. So now we have basically a 45% chance I'm giving for two of the other cases that I can figure out. Now, maybe there's other things that can happen, sure, but this is my best guess as some of the things that could occur. So, first of all, um, one case I could see is like, hey, it does not work as planned. Prices are not capped at all. There, but at the same time, because the let's say 85% of the oil is actually not being subject to the cap, and countries are getting around it, not enforcing it, then this actually would be a positive thing in many ways because what would happen? Yes, Russia is getting the revenue, right? They're not being capped on the revenue, but in response, they're not cutting off supply. So here would be a situation where there'd be very as if nothing happened, right? And so if that actually occurs, that would be kind of for oil, it would have limited effect on the price of oil, a very limited effect on things because essentially it's just all on paper, nothing's actually happening. Now here's a case that I mark it in red because it's kind of a potential issue here. Now in this case, it would be like, okay, it doesn't work as planned, but prices are actually successfully capped. But in response, Russia constrains the supply. So let's say it's like, oh, this is actually being implemented, and Europe and the U.S. and some others countries are actually enforcing this. And in response, Russia is constraining supply. So they're actually right now they're providing approximately what I saw is 12% of the world's supply. Let's say that drops. You know, we're in this situation where you have this, they're the marginal supplier at this point, right? So if you take 10% out or even 5% of the world's supply out, you're going to have a very negative effect. You're going to have a massive upward pressure on oil prices. So if this ends up happening in this way, where Russia is cutting back supply because, hey, we're just not going to sell that oil, forget it. We're not going to sell it at that price. Then this could have some really negative things. First of all, the price of the oil would go up, but then there's a follow on effect. Now, the follow on is that long term effect is that if they really start shutting in supply, so the idea is this: when you're producing oil, you have an oil well, you drill it, you complete it, you do all this stuff. Basically, generally speaking, the oil is coming out on its own. Yes, there's some pumping and stuff, but generally it's like the well is pressurized. It's self pressurized, and the oil is coming up. And the problem is you can't just turn that off. And you need a place to store the oil. So the thing is, if they're producing however many million barrels a day, they only have so many days of storage before look, they have nowhere to put it. And so that means it goes all the way back to the oil well. I was reading some articles on this, and one of the issues is that if you have to shut off the oil flow because you run out of storage, so you can see the chain of events here, right? It's like, hey, Russia is not able to sell their oil. So, whoops, problem one is the price is going to spike because that supply is gone. Simple supply and demand dynamics. Second problem is Russia may have to actually shut off the production of their oil. If they shut it off and have to actually start sealing those wells off, if a year or two from down the road they're not going to necessarily be able to get those wells to produce. And it's interesting. You can read some articles about this, and like it's maybe some of these wells will produce like 50% because basically what they have to do is they have to go down in there and they have to put like a plug in there, like a concrete plug. And then once you do that, it's like, okay, the oil well is plugged. And then if you want to undo that and try to start producing again, you got to go drill through that, and you're liable to have lost the pressure, and you're liable to not get as much out. So my point is that there is a potential long-term kind of a black swan event here, whereas if you take the producer of oil that produces 12% of the world's oil and we mess with them in this way, if they end up shutting in a significant portion of that oil, if they successfully do that and somehow, then you have a situation where are you going to get that oil from? Where are you going to replace that oil from? Right? This could lead to a super cycle of very high oil prices, and I think that's one of like the risks of this whole thing. Now, do I think that that will happen? I don't think so because I have to change this because the the issue is that look, right now China and India are just buying the oil, so they're just gonna keep buying the oil. I don't know if the U.S. and the West can actually stop those shipments or make those be applied to the cap. They talk about secondary sanctions and things like that. I don't know how all that would work. So I think that if we look at this, this is the more likely answer here, that the prices would not be capped at all. Because basically, look, Russia and China are going to continue to buy that oil and at a discount, and they're not going to buy it at a discount to the cap. There's just no way. So this is, I would kind of put this back to, let's say this is like an 80% chance that this is what happens. And then this would be like a 10% chance. Because I think that we already have this outside loop of um, China and Russia working around the current sanctions that there are. In addition, if there are ways for them to get around it. So, in conclusion, what's the deal with this? I think it's a very low probability that this will have the effect that the planners want this to have. It is very, very unlikely that this will hurt Russia in any way. It's just not really feasible to be implemented. The enforcement mechanisms are very weak. It's relying on the individual countries to enforce it, et cetera, et cetera. So in the end, it's just not going to happen. This is another situation where you have these leaders that are just like, hey, we have to do something. We have to do something. So what they're going to do is implement something that's going to do nothing. They really know that this is going to happen. It's not going to work as planned. It's going to have no effect. So I guess in a way, it's a very positive that at least we shouldn't see oil prices spike up due to this stuff. Now, one of the dynamics could be that this might start working, and this might be one of these situations where whoops, the price cap may start working, or it might have an effect, or some countries may be really strict about it, and others won't, and that we might get into a situation where Russia is actually constraining supply. So there is this a potential unintended consequence to this, where you go down this dark path of Russia having to constrain supply, and then it's causing a spike in the oil prices. And there is a risk to this because what you're doing is these central planners they don't understand the market. They don't understand how all this stuff works. They don't understand how the economy works. All these world leaders, they just don't understand it, and they think that they can just tweak this knob and that knob and do whatever they want. And the reality is these are these are complex systems, and what that means is that it's difficult to predict the output of the system, what state it's going to go to next when you twiddle a knob. So even though I would say that there's a lower probability that this would work as planned and cause Russia to shut in, I think there is some risk of this happening, because the problem is they may be successful in some aspect of it. They may be like, well, okay, the US successfully implemented, part of Europe successfully implemented it, and that caused Russia, and maybe Russia can't get enough of the oil to China and other countries that are taking it, and they actually are forced to actually shut some supply in. And if that kind of thing ends up happening, even though overall the price cap scheme was a failure, on the margin, if they had to shut in, 5% of their supply, that could be enough to really push oil prices up. So, in one hand, if you're gambling with this thing, you could say, well, there's sort of a bullish case here. So, let's go look at the oil price chart for a second to get some more perspective on this. So, looking at the oil price, and I'm just going to look at this guy here, the Brent. So, this is the more international price. We could also look at West Texas Intermediate. But you can see here that what's going on with this is, oil prices have come off a lot. They had peaked out at almost, $135 a barrel and stuff like that. But see, one of the things to note is that the long-term average, and this red line is the 50 week, which is akin to the 200 day. So the thing is, you broke the 200 day. But what's really happening, and this very much happens a lot, is you've kind of formed kind of a W, a consolidation pattern underneath, just underneath the 200 day, and your 50's turning around. So, if I look at this from like a trading kind of perspective, this really looks like a kind of a base. The long-term moving average, the 200-day, 50-week, hasn't really turned down. It's flattened. So it really looks to me more of a situation where you've got a bull market going. You've got it way overextended and it pulled off and corrected, but it's really corrected to the long-term moving average. And this just seems to be a consolidation. It really doesn't look like a top. So when I look at the charts, you can kind of see that it's looking kind of bullish for oil. So if you look at also the thing with the OPEC reducing their production, which may not in fact be a reduction, because they weren't actually producing the full cap or the full allocation that they had set up. So they may not actually cut. However, that maybe would reduce potential oversupply in the future. So we have two dynamics going on. Basically, all right, what I'm saying, and this is just me, is I'm sort of bullish on oil right now. I'm bullish just on the technicals and based on what OPEC did. I have a feeling that we're going to see higher prices. And then in addition, if they try to do the oil cap thing and something goes wrong, you could see a spike in oil prices. You could really see that because they don't know what the hell they're doing, and they're twiddling with knobs of the economy and all this stuff that they just could have some unintended consequence, causing a black swan, causing oil to just spike through the roof. There is a risk of that. It'd be nice if our leaders would just weren't so basically believing that they're omnipotent and can figure everything out, because they really can't. I mean, we've seen this time and time again, and yet it looks like it could repeat. So I'm kind of bullish on oil at this point due to all this stuff, even though I think the price cap may in and of itself be like it should be a non-event, but on the other hand, it could turn into an event given just the law of unintended consequences. And then if you look at this here, technically, we're at 100 on Brent. And so, if this thing, like really, it's right at the tip of breaking through this recent resistance here. If it breaks through there and here, it looks like it has a decent shot to go right up into your 122, right up back up to the old highs. This is all kind of on the table for this thing right now. All right. Well, I think that's it for this one. Talk to you later. Bye.